Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Welcome to another episode of A Canadian Investing in the U.S. This week, my guest is Ava Benesocky and August Biniaz. Let's start by going into it a little bit about yourselves. Just give me a little bit of a background, who you are, just so people know who are listening.
Fantastic. Go ahead, August. I always put you on the spot first.
For sure, not a problem. Yeah, my background is here actually from Vancouver. Started in real estate 16 years ago as a licensed agent. I wasn't really good at being an agent, but I was good at finding deals. So I started doing small fix and flips, eventually started my own general contracting company, built single family homes, scaled up eventually to do multifamily syndicated projects. And just over 2 years ago, joined forces with Ava. And we started CPI Capital, which is a private equity real estate firm that partners with Canadian LPs to acquire U.S. multifamily properties.
Right on. And a little bit about my background. I've been in real estate for about a decade, and I helped many real estate investors try to figure out where to invest in Canada here. And August and I, when we came together about 2 years ago, we realized a lot of pain points that existed for Canadian investors, with the median home prices being, 1 million to 1.3 million in the greater cities here in Canada. It's very difficult to scale as an active investor. There's the rigid mortgage laws, and so forth. So our company was kind of formed because we've seen a problem that existed for investors, and we really wanted to find a solution to that problem. So when we came together and joined forces about 2 years ago, we came across this beautiful business model across borders called real estate syndication, what we like to call real estate private equity. And that's that. From there, we've built our company, and we can get into that.
For sure, yeah. And it all goes down to the rental yields that exist in the U.S. A lot of times the question is asked, I'm sure you're in this space and you're a leader in this space, Glenn. So I'm sure the question is always asked, hey, why don't you just buy in our backyard?
All the time. All the time.
In the U.S. and deal with cross-border taxations and compliance issues and deal with IRS and, so on and so forth. And the answer is because of the rental yields. The rental yields are so high in the U.S. is a very business-friendly country. Particular states are even more business-friendly. But the opportunities that exist in the U.S., even with all the cumbersome processes that needs to be taken place as far as investing cross borders and what have you, still makes a lot more sense investing in the U.S., particularly when it comes to cash flowing assets. So it was definitely a no-brainer.
Let's just put it this way: when we both left our careers. And completely left our careers to build this company to help Canadians and bring them diamonds in the rough, it was just a no-brainer for us. So when two people leave their careers and start a journey together, that means that it's really something special. So
definitely. So you mentioned the rental yields. I think a lot of the rental yields, at least the way I look at it, it comes from more expensive markets, right? It gets, as the price gets up, it gets compressed because usually the rent doesn't keep up.
For sure, yeah, that is definitely a factor. Is when property values go up, the rental yields drop, the cap rates drop. That's true. But what that you need two main components within real estate investing to make it the most profitable investment possible. You need cash flow and appreciation. And unfortunately, here in the larger cities in Canada, you have appreciation is mostly a speculation, but cash flow is non-existent. You're actually in negative cash flow in most cases. Mm-hmm. What we notice in the States, particularly in the Sunbelt states, where there is a interstate migration taking place, is that the rental yields are high and the appreciation is there because there is a population growth, job growth. In a conventional mortgage, 70-30 LTV, from the rents collected, you can pay your mortgage payment, taxes and fees, third-party property manager, and still be left over with a surplus to pay investors. So it makes sense to syndicate deals. If you compare the same thing with a multifamily project here in Vancouver or Toronto, you put on 30%, you most probably won't even have enough money left over to pay for your mortgage payment, let alone all the other bonuses that comes with U.S. products. So that was the main point what we realized. And
you get cash flow and appreciation. So that's that's amazing what investors want to see. So that's what's exciting about the U.S.
Yeah. So your journey, you went from Canadian down to building this private equity firm, and I guess it's based in the US, but also probably based in Canada. What are the steps to do this? How are you structured? I assume there's a Canadian corp and a US corp. Maybe just go over it a little bit for us.
Absolutely. I mean, when we first started out and trying to get, more information, obviously with platforms like yours, where you're creating a lot of content and helping Canadians for the option to want to invest in the US. But what we realize is there isn't a lot of content that exists out there when it comes to Canadians investing in the US, and in particular when it comes to raising capital, compliance item that surrounds that, the accounting and what have you. So we spend a good 6 months educating ourselves when it comes to compliance, raising capital in Canada, raising capital in the US, the tax efficient structures that needed to be put together to allow Canadian investors to invest, into a US investment 100% passively and it still be tax efficient. So it was a lot of education. And what we realize is, since we have a background in real estate, but we don't have a background in investing in the US, so it's important for us to attempt to become thought leaders in this space. And we've begun that by starting our own YouTube show, speaking on other people's YouTube shows and podcast. We are very active on LinkedIn, creating a lot of content all the time, meetup groups across Canada. So becoming thought leaders, creating a lot of content, creating a lot of connections, educating ourselves as much as we can, and then to transfer that education to people around us, if it's our investors, if it's others trying to learn. So that was becoming the thought leaders in the space, and then to be able to build a real estate private equity firm, which is pretty sophisticated venture to go down on. And that's kind of the start of it.
Yeah, and I was going to mention, people don't know what they don't know, right? So this concept, when you think of real estate investing, you usually think of being an active investor. So when we started, there's a very fine line that exists between being an active and a passive investor. So when we started getting out there, Glenn, and speaking on different podcasts and really putting content out there, there's a lot of people that were reaching out, sophisticated people, and saying, hey, I didn't realize this concept of passively investing in real estate, a tangible asset, but I just show up and write a check and sit back and build wealth passively through investing in real estate. So it's kind of an exciting concept that a lot of people are really unaware of. So we've kind of made it our mission to get the word out by speaking on podcasts like this, and of course news publications and stuff. But it's really exciting because what we've noticed is we're able to help a lot of people, kind of help the masses build wealth passively, this new concept that people are learning about. So
yeah, so you're doing a syndication. So there's a lot of different types of syndication. I'm guessing that was some of the compliance to figure out what worked best for Canadians to be able to invest in that.
Yeah, exactly. So I mean, there's the security regulations in Canada. Compared to the U.S., every province has its own securities commission. So depending on what province you're raising capital, so the view of the government is that, hey, if you have a business idea and you want to raise capital for your business idea, you have to go through an IPO, initial public offering, and be publicly traded. But that process is very costly and cumbersome. So the government says, okay, that's too costly for you. I'll allow you to use these certain exemptions to raise capital. And some of them are the accredited investor exemption, the friends and family exemption, the minimum $150,000 exemption, the offering memorandum exemption. And when we first started out, as Ava mentioned, the idea was to democratize real estate investing and let everyday people be able to invest in real estate. But what we realized that the system is actually built in a way to make it difficult for the everyday person to invest. So, and so, for example, the accredited investor exemption is the exemption we use. So someone has to make minimum $200K a year, or jointly with their spouse make $300K a year, to be an accredited investor. The other option is they have to have $1 million of financial assets, is liquid assets like stocks and bonds, or $5 million in total assets net of any mortgages. So that's how you become a accredited investor, and that kind of takes out a lot of it. There's a lot of people out. Yeah, a lot of people. It's between 1 million and 2 million accredited investors in Canada, depending what data you look at. In the US, there's 13.5 million accredited investors. So it definitely gets a lot of people out of the process. But it's, as issuers, as real estate investors, we would love to let anyone invest with us as long as they can meet the minimum investment requirement for any particular investment we have. And in most cases, either $25,000 or $50,000 minimum. But the regulation is put into place, and that comes out of because the government doesn't want someone who maybe not be very sophisticated with real estate investing or investing in general, investing in a product that they're unsure of and then losing their money, and they're going to be the ones receiving calls and the complaints. So they see it as, hey, if someone has made astute enough investments that they're accredited investor, they can bear the losses of the risk that exists with investing. But I made a post on LinkedIn, and there was a younger fellow who reached out to me, and he said, hey, if I can't invest like accredited investors, how do I become an accredited investor? If those types of investments are not available for me, how do I build wealth, and how do I get to that financial level to be able to invest? So it was a very interesting comment, and we had a great conversation. But yeah, that's as far as the compliance that it goes, and then it gets more sophisticated when it comes to Canadian LPs investing in US and what have you.
So that's another question. So you use a Canadian LP in order for your top of your pyramid. Is that how you do it? And then in the States, do you use a C Corp, an LP? What kind of stuff do you use to hold all this stuff?
We also use a fund of fund structure. So Canadians invest in our single purpose vehicle here in Canada. And then we create a single purpose entity in the US. The Canadian fund invests into the US fund as an LP. So it's a fund of fund structure. And then if I have US investors who are looking to invest, they invest directly into the US single purpose vehicle. So they're direct LPs into the US investment.
Makes sense. Sounds a little complicated. You could get an accountant working on that, but yeah.
It gets complicated when the U.S. entity, creates the K1s for the investors, but now CRA doesn't recognize K1s, so that K1 has to be converted into T5013, and then individual T5013 for each investor.
Yeah, so it sounds complicated for what we've done, but for a limited partner, a Canadian investor, we've made it really streamlined for them. So they can literally show up and not have to worry about all the complications in the background, and everything's tax efficient, right? So they're relieved from double taxation, and it's very, very passive.
I think that one of our top concerns with investors reaching out to us who haven't invested in the U.S. before is a concern about double taxation and having to deal with IRS. But we had a strong accounting teams that we put into place to assist our investors. And the second biggest complaint is the returns. The returns are so high that a lot of investors actually say, hey, this sounds too good to be true.
Yeah, and another thing for people listening is there's a tax treaty that exists between Canada and the US. So that's why we can relieve them with a foreign tax credit from double taxation if everything's set up accordingly. I always like to throw that out there for a little education.
You mentioned some rates, and I have worked with some syndicators before in the past. Tell me if I'm wrong, but I'm assuming that there is like a smaller rate that you get as like a cash flow every month or every quarter, and then the 20% is the annualized across the whatever 5-year or 3-year or whatever 7-year project you're doing. Am I on the right page there?
So we're purchasing these apartment communities, right? So from the rents we collect, we're able to pay all of our expenses, mortgage, tax as a third-party property manager, still have enough surplus left over to give our investors a cash flow on their investment distributed monthly. So that's the power of that. And then when we have a certain business plan that we execute, it's a very black and white business model. We go in and we do a value add, a kind of a lipstick renovation to the interior and exterior, which appreciates the value of the asset. And then when we sell the asset, Glenn, in a 3 to 5 year term, with the natural appreciation of a growing market that we bought in, our investors then make the money on the back end as well.
Cool. And do you try to keep a certain occupancy level in the properties throughout the project, or do you just, as people leave, you turn the properties over or do the improvements, or what's the game plan there?
Yeah, so we buy stabilized assets, and then when we go in there, we renovate the unoccupied units and allow the tenants the option, hey, for a brand new kind of looking asset, would you like to upgrade for, let's say, $150 a month extra? And then they decide, and we kind of turn over like that. Right now, we purchased our last asset. It was about 90% occupancy, and now it's at about 97% occupancy as we went in there and started making improvements.
And if I may, if you have a follow-up question, or I can add a bit, something here. It's,
Continue.
yeah, I'll quickly add. Now, this concept of value add, which is synonymous with in the real estate investing space, it is always associated with renovations. Value add doesn't always have to be to do with any kind of renovation or deep renovation. There could be other ways to force appreciate the asset or add value. For example, in an asset that we purchased in Orlando, Florida, the developer had just finished building it right when COVID hit in 2019. It was a 350 unit apartment building. They had to occupy it, and they had to bring the occupancy at least to a decent number before they were offloading the project. And they had another project at 350, it was a 550 single family project across the highway that they were building. Yeah. And they needed to basically sell this asset to move to their next project. And they put their rents at 20% below market and occupied it up to 90%. And that was through COVID. So when we purchased that asset this year, the value add was just to come in and bring the rents back up to market. So there was no renovation needed. So this idea of value add is not always.
Yeah, and I wanted to I'd like to just quickly explain the power of value add in a multifamily asset. What happens is when it's very different from single family. The value of a single family home is created by the comparables that are in the surrounding area. Now with multifamily, it's all about the income that the property is making. So when you purchase a multifamily, your sole mission is to increase the net operating income, because what that does when you divide it by the cap rate is that's how you create the value. So when you go into these multifamily apartment communities and you increase the rents, right? So you go and do improvements, increase the rents, it increases the net operating income. $150 a unit on a 200 unit place is going to increase that net operating income, which equals millions of dollars in value creation, which is why these multifamilies are wealth building machines. When people actually look at the numbers, it's really, really incredible of how people build wealth through these multifamily assets.
Yeah, no, I totally get it. And yeah, it just depending for people who don't understand this at all, it's whatever the market cap rate is based on the class of the property and the neighborhood. And you just literally by moving the rents up, just like Ava said, right to the bottom line, just by decreasing expenses, increasing rents, right to the bottom line, apply it to the cap rate, you can create hundreds of thousands of dollars really, really quick.
Yeah, it's really powerful. Yeah.
You mentioned whenever you were turning the property over that do you give the tenants the option to take it as is or to have it renovated and then 150 more? Did I hear that right?
Yeah, exactly. We give the current tenants an option to move into another unit.
Oh, okay. So you move them around.
Exactly, because we're all about, it's a community, right? We're making the community a better place for people to live. We're a very tight-knit community, so we go to the people living there and give them the option if they want to have a newer unit for a premium rent increase. And
also keep in mind, we invest in mostly the Sunbelt red states that they don't have rent control. They have very landlord-friendly laws. Even though when we explain this to our investors and our partners, we're not there to we have a brand, we have a name. If you own a 350 unit apartment building, the brand is very important. There's Google reviews. We can't go in there and just be malicious and increase rents on everyone. You always give the option, have a strategy in place. Even though the laws are in your favor, you're not there to be a shoddy landlord.
Yeah, of course.
No, whenever I'm looking at the landlord laws that you're mentioning, what's important to me is how long it takes to do an eviction. If someone isn't up doing their part of the contract, if we have to make a move, that's what's really important to me, is that I can make that move, which I was a previous investor in Ontario, and it was a difficult situation. it could take, back then it was 3 months. I'm not active in Ontario anymore, but I'm pretty sure it's longer than that now.
Yeah, it's definitely difficult here in Canada with the laws that exist.
If you're going to do this, you're going to build your own private equity company. Are there some steps? What should people do if somebody wanted to try to do this themselves?
Yeah, for sure. I mean, you have to kind of figure out, look inward and see what are your skills and what are your knowledge and experiences. Obviously, educating yourself is the most important part. But private equity is a relationship business as well. Your investors are more important than the deal, so it's important to have that network of investors and nurture that relationship at times, at all times. And to basically, be an astute fund manager, because, a bad deal, people survive through bad deals and hard times, but a bad deal could equal, making the wrong decision or being too eager could ruin a name for a long time, and bad relationship with investors. So that would be my recommendation.
Yeah, definitely. And whenever you're building anything from the ground up, you really look for someone who's done it before. Kind of find a mentor, ask questions. Don't try to reinvent the wheel. That's the number one advice that I would give. There's always, never try to reinvent the wheel, and put systems in place, and just believe in yourself and keep on going.
Awesome. If people wanted to track you down and get a hold of you, see what your current offerings are at the time, or whatever, pick your brain, how would they get a hold of you?
Yeah, of course. We're really active on LinkedIn, actually, Ava Benesocky, or you can send me an email, ava@cpicapital.ca. Super easy to get a hold of.
Jump on our website, cpicapital.ca. Like Ava mentioned, we're very active on LinkedIn. We have a YouTube show, but just get in touch with us.
Yeah, our YouTube show is Canadian Passive Investing Academy, and we bring on all kinds of expert guest speakers. So,
like Glenn Sutherland.
Like Glenn Sutherland was on there.
Yeah, I've been on there. That was a few months ago, I think. Anyway, my timelines aren't good anyway, but I think it was a couple months ago. Anyway, thanks so much for coming on the show. I think there was some great value for people, and some takeaways. I love it. Thanks again.
Thanks, Glenn. We really look up to you, and thank you so much for having us on the show.